Good evening, everyone. Welcome to our Mississippi State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks for taking time out of your busy schedule, especially on a Wednesday night. I know we're just really right in the middle of dinner time, probably. I do appreciate you guys spending some time with us. This is the second installment of workshops that we've done for our alumni partnership with Mississippi State, and really excited to bring this content to you again. Those of you that have not heard about our organization, our company is called American Pacific Mortgage. We started a partnership with Mississippi State earlier this year, and this is a 3-year agreement that we have with our partnership, and we're really excited to bring this information to you. We are a nationwide lender focused in on home buyer education. And so, what we do is we do classes like this. We actually teach over 50 classes through different partnerships throughout the country and get a chance to bring this information to you. So this class is a very interactive session. So as we go through tonight's content, we'd encourage you to ask questions. You can use the chat feature in Zoom or the Q&A feature to ask questions, and I'll be doing my best to answer all those questions live online. This class will run right about to the top of the hour, but we will try to weave in some of those questions and answers. And then at the end, we'll also carve out some time as well. And again, we really appreciate you taking your time to go ahead and get some time to spend with us. One of the things I always love to kind of launch into on our classes is to get a sense of where our audience is joining us from. So if you can, drop in the chat where you're currently joining us from. And the reason why we use that information is because we want to help kind of provide market data for you in tonight's class. So as we're going to talk a little bit about the housing market, it's always interesting to see where you're joining us from or where you want to purchase, because ultimately that will kind of like guide us with some of that market data. So feel free to, if you got a chance, just drop in the chat where you're joining us from, and that will be super helpful for us. Just a little bit about me. Again, my name is Jason Maida. I'm your facilitator and presenter this evening. And I get a chance to work with you on a one-on-one basis to develop a home buying plan for you. So one of the things you'll hear me talk about tonight is that after we leave tonight's class, if you want to sit down and talk a little bit about home buying options, I'll help kind of work with you individually to craft solutions for you. So I would consider myself an expert in first-time home buying. Our team here is a top 100 team in the country. So we were one of the top 100 originators in the country. And really, we're focused in on home buyer education. We believe that we provide the right education, resources, and support to our buyers. That's going to make their path towards home ownership that much easier and that much more efficient, right? So thanks for those of you that got a chance to share some of your information and kind of where you're joining us. Thank you for that. So most of us are in the Mississippi market. I do see a few of us in the Texas market. Very cool. Appreciate that. All right. Awesome. Start from Mississippi. Okay, cool. Marines. Okay, cool. I had the pleasure of spending some time in the South just a month or so ago. And I got a chance to drive through Mississippi and Alabama and the Tennessee markets and stuff like that. I got a chance to actually, I was on campus at Mississippi State just a month ago, and it was great to get a chance to get the tour. And everything was a little bit quiet because, of course, it was the summer season, and so students weren't back on campus. But I know things are ramping up again, and gosh, well, we got football season starting, so we're not too far away from that. So that's pretty exciting. Or actually, we're just on the cusp of that. So really exciting. But it was really great to be in person on campus to just kind of see what you guys have experienced as past students at Mississippi State. So again, thanks so much for joining us tonight, and let's talk about our talking points for this evening. So we're going to spend some time looking at the housing market, like I just mentioned just a few minutes ago. We're going to then kind of talk a little bit about interest rates. There's a lot to cover there, a lot to unpack, especially with what's going to come probably down the pipeline in the month of September. We want to spend some time looking at what we call as a rent versus buying analysis calculator. So I'm going to walk you through that. Spend some time looking at credit. We're going to talk a little bit about student loans and how those can impact your eligibility for purchasing, loan programs that are available to you, the documentation that we'll generally want to gather as part of the home buying process. And then we'll kind of look at some first-time buyer programs available in your state and any state that you're trying to purchase in across the country. And then finally, we'll wrap up by taking a brief look at the loan process. So after tonight's class, if you're thinking, you know what, I think I'd like to learn a little bit more about putting my plan for home ownership together, we're going to tell you about how you can get connected with us for a free consultation and design a plan for you and take you through that home buying process. All right. So let's talk a little bit about home buying. This is probably going to be one of the biggest financial decisions you decide to make, whether that's this year or next year. It's going to be a big decision for you. So obviously, you guys realize the gravity of that because you're spending some time in a workshop on a Wednesday night, right? And there's a lot of great benefits that come along with owning a home. So when we think about affordability, so we're trying to basically control our monthly budget, and homeownership can allow you to have more of a fixed budget. There's a potential for growth in equity of your home. What that means is that as your home appreciates over time, the difference between where your value now goes to versus what you owe on your mortgage balance, those differences are called home equity. And that home equity can now translate into wealth growth for you, potentially generational wealth. And so there's a lot of great benefits that come in or out around home ownership, and finally, there's tax benefits that come along with home ownership. So potentially the tax deductibility of interest in owning a home. So as we coach clients on first-time buyer opportunities, we really try to encourage them to think through their budget as it not being such an apples to apples comparison. It's completely different. It's more of an apples to oranges comparison because there's a lot of great benefits that come along with owning a home. And so one of the things we like to launch into with our classes is to start with this rent versus buying calculator. And so I shared it up on screen here, and I'm going to walk you through an example. These are just some pre-filled data points for us for tonight's class. Obviously, depending on where you want to purchase in the country, it might look a little bit different for you, but I want to kind of walk you through this. By the way, tonight's class is being recorded, so tomorrow morning, this video will be up on our YouTube channel. We'd encourage you to do some look backs to tonight's content if you missed one of our topics we covered. And in fact, share that with your friends or family, maybe some coworkers that are also thinking about home ownership or just want some tools. Have them check that out. And we'll also include all the presentation materials. So we do have all of your emails from signing up for tonight's class. So we'll make sure you get our entire presentation as well, too. All right, so let's talk a little bit about this calculator, and I'll walk you through it. It first starts with where I'm paying from a rent perspective. So we kind of pre-filled in $22.50 in rent. We assume that we're going to be paying renter's insurance as renters at $15 per month. We assume that our rent will increase by 5% on an annualized basis. So as I decide to renew my lease, that lease payment will increase. And then when I look at from a home purchase perspective, I'm looking at comparing to buying a $450,000 home. I do realize, for some of us in some lower cost of living markets, that number might seem massive. So, what I would encourage you to do is to use this calculator on your own, maybe plug in 250 or 300, whatever the number is that fits the criteria that you're looking at. And then that'll obviously give you your comparison. But in this case, we're going to use $450,000 for our purchase price. We're going to talk about loan programs tonight, but one of the things we'll look at is the minimum down payment as a first-time buyer. So if you're buying at $450,000, minimum down payment is 3%. We have estimated property taxes. Those will vary for us depending on where we're going to buy in the country. I know some of our guests are going to be looking in the Texas market. Texas can tend to have a little higher property tax base than maybe, say, other states that we're looking at, but the tax rate will be based upon the community that we're going to buy in. And then we also have homeowners insurance that we factor into our budget, as well as maintenance costs of our home. So that's kind of the side of the homeownership piece of things. Now, when we look at loan information, that's our next tab. We assume a 30-year fixed mortgage. We have an average interest rate of 6.25%. That can vary based upon credit, down payment, what your amount financed is. We'll talk about that in just a bit. And then we have origination costs. So that's what a lender charges you for your financing, also known as closing costs. Now, we generally recommend buyers to budget about 2 to 3% of their overall sales price for closing costs. So that can vary based upon your type of your transaction. Now, one of the added benefits we have in our partnership with Mississippi State Alumni is we actually discount our origination charges by $750 to make it more affordable for you to obtain homeownership, more cost effective for you in general. And then there's also discount points that you can pay as a consumer, which allows you to bring down your interest rate. So let's say you want to really achieve a rate of 5.75%. You can pay additional funds out of pocket to bring down that interest rate. However, I don't really recommend in today's market to pay discount points because the reality is investments like that are usually 3 to 4 years. So it takes us 3 to 4 years to break even. And most of our clients buying in today's market will probably look to refinance in the next 1 to 2 years once rates more normalize. So that's what discount points are, but not necessarily a make sense in today's market. We also have other settlement services. Those are going to be things like title, escrow fees, attorney fees, transfer taxes as part of your home purchase. That all is inside of that closing cost to purchase our home. So you're going to hear me talk a little bit about savings tonight for home ownership. Two kind of components to saving up for home ownership is going to be around down payment, which can be anywhere between 3% to as much as you want, 20–25% of the purchase price. And then you have closing costs, which are 2 to 3% on average of the purchase price. So what our calculator does, and actually let me get through one other section here of the calculator. So we have the other assumptions too, which basically assumes that our home will appreciate by 4%, that we'll be in a home for 7 years, that it's going to cost us about 10% of the price to sell, when it comes to realtor commissions and when it comes to fees like closing costs to sell our home. By the way, just to make a quick side note on realtor costs. So you may have seen online changes in how realtors are commissioned in working with buyers in real estate transactions. So just a week ago, the National Association of Realtors settlement, was instituted. So basically, it changed the way realtors were compensated. So most realtors have buyer agreements to represent you as a buyer. I would encourage you to talk to a buyer's agent once you're on that path towards homeownership about how they're compensated, because there's negotiations that happen with that. Okay, so you might see some kind of things online about that. So I want to kind of bring that to your attention. Then we have state and federal taxes in this calculator, and then finally the savings rate. So what our calculator does, that we first kind of gives us a little bit of a side-by-side comparison of what the payment's going to look like. Okay, so if we compare this $2,200 rent versus our $3,700 home ownership payment, clearly a big difference, right? That's a $1,500 variance between renting versus buying. However, if we were to compare that side by side for the next 7 years, if we were to continue renting versus buying, we're going to lose about $65,000 in opportunity costs that we have on the buy side of things. Now, how do we get there on the buying side being more positive than renting? Well, we got to think about the appreciation of equity over time, right? Over the course of the 7 years. And then we also have those tax benefits that come along with owning a home. So when we have those two components, which are pretty huge opportunities in home ownership, that's where it creates the $65,000 improvement of buying versus renting. Now, everybody's situation will look a little bit different. We'd encourage you to take a look at that calculator. I think that'll be super helpful for you to better understand what your benefits look like in home ownership. And the last thing I just want to comment on the calculator is that most of our clients that are buying in today's market are probably going to refinance in the next 2 or 3 years down the road. So while I might be buying a home at 6.25 or 6.5%, whatever the number is, hopefully when rates more normalize in the next year or two, we'll see rates at a level that will make affordability that much better for home buyers. All right, so let's talk a little bit about the housing market. I know we have an audience that's all across the country, which is awesome for us. And so what we want to do is kind of share with you some trends across the country from a national perspective, what we're seeing in the market. Most housing markets, believe it or not, in most parts of the country look about the same right now in terms of the trends. The number might look different from a sales price perspective. So like median sales price across the country is $438,000. Now that may be $230,000 in Mississippi or $350,000 in Texas, but the trend looks very similar. So you see this kind of downward move here. And that's kind of prices softening a little bit, but I would imagine that's kind of flatten a little bit if we were to push this out a little further. What's going on in the housing market is a few things. One is buyer demand has been pushed out a little bit in terms of the timing of buyer demand. What I mean by that is typically in the housing market, we see a lot of buyer demand in April, May. So the spring months, and the weather starts getting a little bit nicer. Everybody's kind of wind down a little bit. We're now thinking about getting ready for the summertime. It also starts getting people thinking about home ownership. Where do I want my kids to go to school? Those kind of things. So generally that happens in April, May. But with the current rate environment, I think that's changed the mindset and pushed a lot of people to looking further out. Namely, we saw that in July of this year. So now that the buyer demand was pushed back almost 3 months. And in that, I think the consumer is saying, well, you know what? I don't think rates are going to move that much. So we want to try to get into the market. So we've seen really an uptick in demand in homeownership in July and August, and now moving into September. The other thing that's moving in the housing market right now is inventory levels. There's just not a lot of inventory out there to support buyers, whether that's new construction or it's resale homes. I'm getting more and more questions from clients about purchasing land and building, which it's very difficult to do right now because there really isn't financing outlets to acquire land or to construct. So, I think as we move forward in the market, we're going to have to get better surplus of homes out there, because as we get into a lower rate environment, buyer demand continues to push up, right? So as rates go down, which we will see rates go down, and we're seeing signs of it already, the inventory is going to have to change, because if not, then we'll start to see prices elevate. And that will be really for all markets across the country. When we look at interest rates right now, we can see a nice little trend here developing, where we're starting to see interest rates start to soften a little bit and go down. A lot of you in tonight's class are probably even paying attention to what's being talked about in the news outlets about the Federal Reserve potentially cutting rates on September 18th in their next meeting. And I think the question, and that we need to kind of understand a little bit, is, why is that the case? Well, the Federal Reserve has raised rates over the course of the last 2 years to combat inflation. The Federal Reserve's goal on inflation is 2%, and we're still above that, although we've improved a lot. However, we're not seeing a lot of job creation out there, which is leading to the Federal Reserve to believe that the economy is slowing down a little bit. In fact, tomorrow we're going to see the gross domestic product numbers come out tomorrow. We're going to see what the economy is doing. But because of kind of a potential slowdown in the economy and inflation starting to slow down a little bit, we'll probably see the Federal Reserve kind of come back off of their rate hikes now and probably cut rates anywhere between 1/4 to 0.5%. Now, I think it's important to understand, because it will be a bit misleading in the news outlets, is that just because the Federal Reserve decides to cut rates next month doesn't mean that mortgage interest rates will fall immediately. It is kind of a gradual progression of interest rates coming down. So it's not a 1-to-1 ratio type of thing. Mortgage interest rates move daily based upon changes in the economic climate. But I do think we're going to, as we go into September and finish off the end of the year, we're going to see rates start to slow or come down a little bit. We'll probably see rates in the low 6s as we wrap up 2024. And then hopefully sometime in 2025, we'll then start to see rates get into that below 6%, high 5s level. Okay. But clearly we've had a rocky ride interest rate wise in the last 12 months. I mean, October, we peaked at like 8% interest rates. And so we're a far cry from that in today's market, but certainly it's important as a consumer to understand where we've come from an interest perspective, how we got here, and kind of where we're going. Now, not all interest rates are the same for all buyers. There's various characteristics that go into interest rates, like credit eligibility, the type of product I'm going to use, how much I'm deciding to finance, what my down payment is. We talked a little bit about discount points. Do I want to buy additional costs to bring down my interest rate? Do I want to shorten the term of my loan to lower my interest rate? All those are things or levers that we can pull to try to help make affordability happen for our buyers. Now, as we meet with you for a home buyer consultation for you, we're going to figure out what the right path is for you towards home ownership, what type of product, interest rate, payment solution makes the most sense for you as we design this plan. Now, there's two usually challenges to home ownership for first-time buyers. It could be one, savings, because I just haven't had a chance to save enough for home ownership for my down payment, my closing costs. But it can also be around credit, maybe because I'm a little bit overextended, or because I've opened up new accounts, or maybe I just don't have a lot of credit. So in our classes, we like to kind of spend some time looking at credit and giving you some guidance and resources towards that. Many of you in tonight's class have monitoring services like Credit Karma or some of the agency products to help you monitor. But I think it's important to understand there are 3 different scorecards to credit. There's a auto model for auto financing. There's credit card, which most of the credit monitoring services use. And there's also the mortgage model, which of course we're going to use for home mortgage financing. This is the score calculation that we use on that mortgage scorecard. So 15% of it is going to be how long I've had credit. 20% is going to be how many new accounts am I trying to open. Also, am I having a bunch of hard inquiries on my credit? That's going to affect the 20% of the score. One kind of side note for us is that in part starting our process with our team, we only start with a soft credit check to look at your options. And the reason why we decide to do that is because many of our first-time buyers are on a longer path towards homeownership. Many of our clients, it's 1 to 2 years out from attending a class. So we don't want to impact their score with a hard inquiry. So that's why we start with a soft inquiry. And then 30% is going to be around revolving credit, and that's called utilization of credit. We're looking at like credit cards, lines of credit, things like that. We're taking your credit limits versus your credit balances. So that ratio is credit utilization. So if I have $5,000 in balances on my credit cards, but my credit limit's $10,000, that means I'm at 50% utilization of credit. Now, ideally, if I was to say what's the optimal percentage level, I would say 10%. And if we're running a little bit higher on our credit cards, maybe we're at like 80%, I would encourage that client to try to start working to get below 50% utilization. The last component to the score calculation is payment history. That's pretty simple. That's how long, how well I've paid my debts over the course of my credit record. If I have late payments, they're rated as 30-day late, 60-day late, and 90-day plus delinquencies. So the more severe my delinquency, especially in the most recent 20 to 12 to 24 months, that's going to have the biggest impact to my score. Now, one tip I want to circle back to credit utilization. I want to give you a tip to manage credit utilization. So for those of you that have an active credit card, there's two important dates on your statement. One is the statement or billing cycle date. The other is the due date. So many of you are in the practice of paying on your due date, which is totally fine. But to manage down utilization and get improved credit, here's what I would do to switch that practice up a little bit. Try to pay off or pay down your credit card before the end of your billing cycle date or statement date. Why that is important is because at the end of that statement date, that's when the credit card issuer sends out all your payment information to the credit bureaus. So if you can pay that down before that due date, two things are going to happen. One is you're going to have lower utilization of credit. And so now you're going to have a better utilization level. And now you're going to be able to show all that good payment history to the credit agencies, which could potentially lift your credit score. Now, major events on your credit report like bankruptcies or short sales or collections, maybe charged off accounts, those are going to have a bigger impact to your credit score than, say, just a 30-day late. But really, the events that have happened in the last 12 to 24 months are going to be the most impactful to your score. So if I've had a late payment, let's say in October of 23, well, I'm still inside of 12 months of that, so I'm probably still feeling the effects of it. But as I continue to show on-time payment history and then move further away from that event, then I should see an impact in my credit score, a positive impact, I should say. Now, if you've decided to balance transfer some accounts and maybe close out like an old account, be careful of that because that could negatively impact your scoring. Because if you close out a revolving credit account, it can do two things. One is it basically takes that history of that account and completely wipes it out of the model for crediting. But it also lowers your available credits. So if I had a $10,000 line of credit and I close it, then I've just lost some of my available credit and could hurt my utilization of credit. So just be very careful about doing that. Now, there are three credit scores that come out from each one, and we have one for each agency, right? So the three agencies are TransUnion, Experian, and Equifax. Each one of them have different risk scorecards, and they have each different scores. Now, we take the middle score of all three scores. So for example, if I'm applying for a mortgage, my highest score is 760, my middle score is 740, my lowest score is 720. We're going to take the middle score of 740 from a qualifying perspective. Okay, now that's if I apply individually. Now, if I add my partner to the application, my partner's 720, 700, 680. Well, my partner's middle score is a little bit lower, it's 700. So in that case, we would use the lowest middle score between both borrowers. In this case, would be 700. All right. So let's show you a quick matrix on kind of past late payments, just so you can get a sense of how long they'll stay with you on your credit report. So hard inquiries will be there for 2 years. But again, most recent 6 to 12 months, I think is where I'd be looking at on hard inquiries impacting your score. Events like late payments, 12 to 24 months. This is how long they'll stay on your credit, but I'm talking about the impact it'll have to your score. All right, before we hop into student loans, I want to put it back to the group. Any questions so far on some of the content, questions around credit, anything like that that I can help answer for the audience? All right. Okay. Well, again, you can use your chat function or Q&A, and we can definitely answer those questions for you on air. Let's talk a little bit about student loans. Obviously, most of us will face student loans at some point if we already paid those off. Now, I do realize some of the student loans have some forgiveness features to them where some student loans have been forgiven. If that debt has been forgiven and we have documentation of it, then we don't have to factor student loans into the qualifying. But if I do have active student loan balances, whether I'm in forbearance or deferment because I'm back in school, we still have to count a minimum payment for qualifying on student loans. Now, if I'm on an income-based repayment program, let's say I owe $75,000 in debt and I have an income-based repayment of maybe $250 per month, then that $250 amount is what we use from a qualifying perspective. But if I haven't entered repayment, but I'm still on deferment and forbearance, then there's different calculations we use. So on an FHA loan, we always use 0.5% of the aggregate balance of those student loans. And then for a conventional loan, which we're going to talk about these loan features in just a minute, we would use 1% of the aggregate balances for qualifying. Okay, so that question comes up often from our clients, especially as we work with so many different alumni partnerships across the country. So many of us have student loans that are active. And so hopefully that kind of provides you a little bit more around what we look for on student loans. But regardless if they're in active payment or not, we do have to count a minimum payment for qualifying. All right, let's kind of dive into some of the loan programs that are available to you as a first time or even a second or third time buyer. We're going to give you kind of a high level look at each one of these products. These are kind of 5 of the core programs for buyers, and we'll kind of spend some time looking at the features and benefits of each one of these programs. And the first one is a conventional loan. That's a Fannie Mae, Freddie Mac loan. You might have heard those terms floating around before, right? Conventional loans are one of the most popular products. They account for about 70% of all originations across the country. Depending on what market you're in, meaning what county you're going to purchase in, there's different loan level limits based upon that county. Now, there is a conforming limit for these loans across the country. It's the same for everyone. But if you're in a high cost of living area, we could potentially go to a higher loan amount. So the conforming limit across the country is 766,550. That limit is updated every year based upon cost of living adjustments. Now, you can finance under conventional up to that loan amount with a minimum down payment of 3%. Okay. Now, the minimum credit score for a Fannie Mae Freddie Mac loan is 620. I know we have someone, I think, in the audience from Virginia. So Virginia has like high cost of living areas that we could potentially finance up to 1.149 million. That space above the conforming loan limit and we call it high balance, that 1.149 number, that does elevate the down payment from 3% to 5%. Now, we're going to be doing some comparison tonight between the conventional loan and the FHA product. And so I'll kind of talk back and forth between those particular products, but let's kind of dive into the FHA product now. FHA is a government insured loan, and it does have a minimum down payment of 3.5% up to a maximum loan amount of $498,250. But that loan amount can change based upon where you're going to purchase in the country. So if you were out in Los Angeles County in California, you could take that loan amount up to $1.149 million. But depending on what the cost of living looks like, that loan amount adjusts accordingly. FHA is going to be a much more flexible product than, say, the conventional loan product. So the credit scores are a little bit lower at a 580 minimum versus 620. But you heard me mention that example about a late payment in October of 23. Well, that would be probably a little easier from an underwriting perspective on an FHA loan, whereas a conventional loan might be a little bit more challenging. The FHA loan has mortgage insurance, and we're going to do a kind of a conversation around that in just a few minutes. But generally, as first-time buyers, most buyers are going to be looking at either the conventional loan or the FHA product. Now, for our veterans that have eligibility, there's the VA home loan. It's an amazing product. allows a lot more flexibility and accessibility for our veterans to lending options. It's a zero down payment option. You can go above $1 million or more. There really is no limit on loan amount for the veteran. And then the veterans have that flexibility and guidelines. So whether I had a late payment a month or two ago, or maybe a year ago, might be a little bit easier from a qualifying perspective. We look at the expense versus income ratios, a little bit more, a more relaxed position on that, just again, provide more access to home ownership for the veteran. Now, the next product is the USDA program. That's for clients that want to purchase in more kind of rural areas. For those of you who are in the Mississippi market, and I know many of us are in tonight's class, there are counties within Mississippi that have qualifications under USDA. USDA stands, like we probably assume, as the United States Department of Agriculture. And so there's two qualifiers to that particular product. It's based upon your income by household, and it's based upon the geography or the location of your home. So there's a lot of markets that we've looked at in the Mississippi area that do qualify under USDA. The big advantage there is a no down payment option, whereas you have down payment required on some other products. And then with USDA, there's two guarantee fees. There's a 1% guarantee fee, an initial fee, and then there's a monthly guarantee that's the equivalent of roughly 0.35% of our total loan balance. And then finally, there's the jumbo loan, and those are for clients that need to finance a little bit more than maybe what the Fannie Mae or Freddie Mac limits can support. Doesn't really happen, quite honestly, for a lot of our first-time buyers, but I just want you to know what the resource looks like. It allows clients to finance above those conforming or high balance loan limits. Minimum down payment is usually 10 to 20%, so it's a lot greater down payment. It's a little bit different with the jumbo product because you have to save up for down payment and closing costs. But there also are additional asset requirements, and we call those reserve requirements, where we have to have at least 12 months equivalent of our monthly payment in additional resources. So if I have an $8,000 mortgage payment, we'd have to have an additional $96,000 left behind in assets. Now, we've talked a little bit about PMI already, which PMI stands for private mortgage insurance. So there's private mortgage insurance, which would be centered around a conventional loan, and there's government mortgage insurance that is on an FHA loan. So let's kind of dive into each one. I wanted to explain a little bit about what that looks like for you. And private mortgage insurance or government mortgage insurance insures the lender against default by the buyer. And with a conventional loan, there are different payment options in how you pay for the mortgage insurance. It can be done monthly. You can split the MI up into some of it monthly, some of it upfront. You can do single premium where you completely buy out the mortgage insurance. And then there's lender paid mortgage insurance where you're basically taking an elevated interest rate in order to buy out the mortgage insurance completely. Most clients will take the monthly mortgage insurance option. The reason why that is because on conventional mortgage insurance, once you reach 2 years in your loan and you have 20 to 22% equity, you can apply to have the mortgage insurance canceled. Now, mortgage insurance is not the same for all buyers, and I think that's really important to understand. So for some of you in tonight's class, if you've even started your home search and used some of the calculators on Zillow or Redfin, many of those calculators are not quite accurate because they don't have mortgage insurance set up correctly. Mortgage insurance is based upon your credit score, what your down payment is, and then how much you decide to finance. So it can vary for each buyers. In fact, if we look at a scenario down here at the bottom on a conventional mortgage insurance, say financing $250,000 with a credit score of 740 and a down payment of 3%, my mortgage insurance is about $135 a month. Okay. If you were to do that same calculation on Zillow or Redfin, it's probably $100 or $150 more, just because it's not really set up correctly based upon the characteristics of truly what's in mortgage insurance. And as we meet with our clients for home buying plans and those consultations, we'll figure out your exact mortgage insurance amount. The next side of this slide is the FHA side. So it's a government insured loan. FHA stands for the Federal Housing Administration. There's two forms of mortgage insurance with FHA. There's monthly mortgage insurance, which is 0.55% of my total loan amount, and then we divide that by 12. That's how we come up with that number. There's also upfront mortgage insurance, which is 1.75% of my total loan amount. That gets added into my total amount financed. So FHA mortgage insurance is going to be a little bit more expensive than a conventional loan, and let's take a look at that example. So if we take the same $250,000 loan amount, we add on the upfront mortgage insurance, which is $4,375, and then the monthly mortgage insurance would be $114.60. So FHA mortgage insurance is a little bit lower than the conventional side. And that's just kind of the way the numbers factor out. But at the same time, FHA will be a little bit more expensive overall because of the upfront mortgage insurance. Now, most of our clients would probably want to lean more towards the conventional side, but it really depends on eligibility and how the fit is from an underwriting guidelines perspective. So, if I did have that late payment back in October, FHA is going to give me a little more flexibility, whereas conventional, it might be a little bit more challenging. So, depending on the best fit for our clients, we're going to kind of tailor the right solution that makes the most sense for them. And as we kind of wrap up on this screen, I just want to kind of make a quick note for our audience. If you've already started looking at rates online, you may have looked at rates and didn't realize that the rate that you saw online was actually an FHA loan that might be 0.5% lower than a conventional loan. A lot of clients don't understand that the FHA loan, while the rate may look lower than a conventional loan, the fee structure, like the mortgage insurance, is going to be a lot more expensive. So just something to kind of take note of, because as I meet with clients all across the country, someone's doing a Google search of rates and says, "Wow, rates are 5.5 on an FHA loan, and why is this conventional loan 6.25?" Well, the difference is the expense structure around mortgage insurance. All right. Any questions so far? I know I'm throwing a lot of concepts out at our group, so I want to make sure that there's any questions from our audience so far in tonight's class. Let me do a quick scan of. All right, so there's a question that came in on the chat, which is, are there any benefits to joining a credit union? I guess it depends on the credit union. I don't work for a credit union. I work for a direct lender. I have had credit union accounts in the past. I think it just depends on your affiliation with the credit union. Sometimes there can be promotions for checking accounts and credit cards and stuff like that. So it really just depends. But yeah, good question there. Let's talk a little bit about documentation that's typically needed on this path towards homeownership and designing your plan. Now, we're going to talk about that, but I also want to spend some time talking about income when it comes to qualifying for financing. Generally, we're going to need the last 2 years of taxes and/or W-2s, last 2 months of bank statements, and 60 days of pay stubs. If you are self-employed, we do need the last 2 years of filed tax returns. Now, you may have heard about the 2-year employment rule, and I think that gets a little bit lost in translation because the way the 2-year employment rule works is that I have to have 2 years of job history and/or education combined. So for some of you in tonight's class, you may have just recently graduated from Mississippi State and now you're starting your careers, which is great. If I have 4 years of undergrad and now I just started my job here in the spring, that 4 years undergrad counts to the 2-year qualifying. Okay. So I just have to have 2 years education and/or employment to be able to meet that 2-year requirement. Now, where it gets a little bit different is that if I have 2 jobs right now and both are, let's say one's a 30-hour work week job, the other one's a 20-hour work week. If I want to count both sources of income, then I have to have a combined 2 years on each job simultaneously. Same thing holds true with self-employed clients. So if you're self-employed, we do have to show that you filed 2 years of taxes as a self-employed individual. That would also include independent contractors that get 1099s. That would be a 2-year requirement on tax filings. If I have, let's say, commissions or bonus income, any type of variable sources over time, in order for a lender to count those variable sources, in that case, I do have to show that I'm on my job 2 years simultaneously. Now, if I just am qualifying off base salary, for example, maybe I make $60,000 base salary, I can use that income to count right away. But it's the variable income sources that can be a little bit challenging from a qualifying perspective, because in that case, we do have to show that you've been on that job for 2 years. Okay. Now, some of our clients do have side jobs like Uber or Lyft, DoorDash, whatever it might be. Those sources can also be used in qualifying, but it is technically independent contractor income. So we have to show 2 years of tax filing for those income sources, and it has to be simultaneously 2 years with my full-time job. And then finally, if you do have other streams of income, like let's say you have a partner that's contributing to your household income, or you're renting out a room, those sources generally can't be used. Now, if your partner wants to join you on the application, then certainly that income can be used, assuming they qualify along with their expenses. But other sources like that can't be introduced unless they're documented on the application. Now, one of the ratios that we look at in qualifying is called a debt to income ratio, and it takes into consideration your pre-tax income versus your expenses for owning a home, as well as your other obligations that you have. Generally speaking, we don't want those expenses to exceed more than 43 to 45% of my pre-tax income. Now, that's just a metric that we use from a qualifying perspective. It doesn't necessarily indicate affordability. So affordability is a conversation that we're going to have as part of a consultation with you to figure out what the right roadmap is for you for home ownership. What's the right budget for you with home buying? There's two big goals for us in home buying for you. One is we want affordability. So we want to design something that fits like within your budget that feels comfortable. Secondly, we want to make sure that's sustainable over time because things can change economically for you, and we want to make sure that homeownership is sustainable for you over time. This is the debt to income ratio calculation. So it's pretty simple. We take the principal and interest of your new loan, the property taxes for the new house, homeowners insurance, homeowners association dues if you're buying generally like a condo or a townhouse, and then your other debts like credit cards, car loans, student loans, stuff like that. We take those expenses versus your gross monthly income, and we come up with this ratio, which in this case for this buyer, their debt to income ratio is 35.29%. So that means 35% of their pre-tax income is consumed by those expenses. Now, the question I get often is, well, where should my debt to income ratio be? And that really varies for a lot of buyers. I'd say in meeting with buyers all across the country, I think the sweet spot is like 33 to 36%. Keep in mind, qualifying can go up to 43 to 45%. In some cases, can be as high as 50%. But we want to make sure that affordability piece is hit for you. We want to make sure we hit the mark when it comes to budget. So it does vary for every household that we work with, but the general rule of thumb, I see the comfort zone around 33 to 36%. All right, the last topic we want to kind of cover in tonight's class is going to be around savings for our down payment and closing costs. And so I want to talk really quickly about the sources that we can use for down payment and closing costs, and then kind of give you some tips on a savings plan for home ownership. It's pretty simple from a documentation perspective. If we've saved up money, the last 60 days of statements, we'll want to reconcile those. You can't introduce cash in terms of transactional cash into home ownership from a down payment perspective. You can use 401ks, 403bs, IRAs. I would encourage you to talk to your tax or financial advisor before you access those type of assets. And family members can also contribute towards your home purchase. Those are called gift funds. And so there's a way we document those assets, but those can certainly be used in the home purchase. Now, as we think about savings for home ownership, again, that's one of the two challenges for first-time home buyers. I want to give you a quick, kind of way of looking at creating a savings discipline. And so it would look something like this. So if I'm currently, let's say, paying $2,000 in a month in rent, but let's say from a homeownership perspective, I feel like I can budget myself to $3,500 a month if I bought a house because I'm willing to make some concessions on things. Well, if I could change the way I save on a monthly basis by doing this one simple thing, start making payments to myself like I'm paying a $3,500 mortgage payment. So when I write my check for $2,000 or do my bill pay or transfer money to my rent for $2,000 a month, also include $1,500 additional that would be transferred into your savings account. And what happens with that, there's two kind of big things. One is that savings account, of course, grows over time. At the end of 6 months, we're at $9,000. End of the year, maybe we're at $18,000, not including high yield interest accounts that could pay you 3% and 4%. So now we're seeing that savings grow for us. But it also creates the discipline on your budget that, hey, I'm pretty good with $3,500 a month in expenses, and I've created that habit. So now when I do start really getting serious about home ownership, that it's not such a big leap to go from $2,000 to $3,500 because I've been doing it, right? So that's what I would encourage you to do because savings can be one of those challenges towards home ownership. Now, there are resources that can help you, like first-time home buyer programs all across the country. We're going to spotlight some national programs and then one for the state of Mississippi. But each state usually has what we call an HFA, a housing finance agency. They're in, they're Texas, they're in Maryland, they're in Virginia, California. So it really just depends on where you're at. Let's talk offline if you're interested in some of those things. And certainly when you do a consultation with us, we'll design that as part of one of your home buying plans. Most first-time buyer resources like that are designed for low to moderate income households based upon the median income for the market that you want to purchase in. Now, nationally, Freddie Mac, who you heard a little bit about earlier, offers a national program to assist in a grant of up to $500 to $1,500 towards closing costs. Not a lot, but it is helpful to help reduce down some of those expenses. In the state of Mississippi, there is the MHC Loan Products Assistance, which allows $6,000 to $10,000 in down payment assistance. And there are opportunities for 30-year fixed mortgages through the product. So usually when you elect a certain first mortgage product with an agency, like in the state of Mississippi, then based upon the interest rate selection that you have, you'll have certain down payment assistance resources that are available to you. So usually the higher you take the first mortgage rate, the more resources you'll get from the state. And again, those are things that we can talk about as a one-on-one session for you to figure out what the right fit is for you. But I think it's important to understand as first-time buyers, a first-time home buyership might be much closer to you than you think. A lot of our clients, when we first meet with them, think they're setting 2 to 3 year goals. But when we implement resources like state first-time buyer programs, it could be more of a 6 to 12-month goal because we have those resources available to us. Plus, instituting savings plans like we talked about can make homeownership just much more of a near-term goal for you. All right, so we're almost to the end of class, but I want to spend some time talking with you about the buying process. And this is our 6 steps of home buying that shows you the milestones of buying a house. So coming out of tonight's class, you may be a little bit more interested about home ownership. I hope you are. Hopefully you have 1 or 2 things that you're taking away from tonight's class that you're like, hey, that's pretty cool stuff. And if you're interested in getting connected with us for a consultation, that's a one-on-one session with me for 30 minutes. So I'm going to give you some more information on what that looks like in just a bit. But the output of a consultation with me would be to get you pre-approved for home ownership. And that pre-approval is basically a certificate that allows you to go out and start making offers on homes. I generally get a chance to meet with 5 to 10 clients per day to design home buying plans with them. And that pre-approval is good for 60 days. And that will kind of get us through first step, or step 1, I should say. And then we move into the house hunting phase. And many of us have already started that, right? You may have just started that before you came to tonight's class because it's accessible, it's online, right? You can get on Zillow or Redfin or other different tools to see what homes are on the market. But step 2, you now have kind of the framework of a budget and know what you should be looking for. And I would encourage you to get connected with a realtor that's a local in your market, that's kind of an expert there that can show you options that fit your qualifying numbers for you on your financing. Now, that pre-approval letter that we provide to you is a certificate. It can be edited based upon what you're finding in your home search. So if I get pre-approved for $300,000, but I really find a house that I'd love for $250,000, we can always edit those pre-approval numbers down, because when the realtor presents the offer to the seller, we generally want to see that pre-approval letter match the offer price. Now, let's say that $250,000 house is just checks all the boxes. We make an offer, that offer gets accepted. Then we move to step 3, and that's called entering escrow. So that means the seller has accepted our escrow or offer, and it starts the escrow process. Usually from step 3 until when I get my keys to the house, it's about 30 days. Now it could be different timelines based upon where you're buying in the country, but a baseline number is about 30 days. Now, the same day your offer gets accepted, you're going to get a call from us and from our team and say, hey, congratulations. You now have an accepted offer. Let's talk a little bit more about what's inside of your contract and some of the timelines, and then schedule you for your follow-up video consultation. And that's where I get a chance to meet with you one-on-one for a 30-minute session, just to kind of reaffirm a lot of stuff that we talked about in your pre-approval, like what's the interest rates look like today in the market, what's our payment going to be, what's our out-of-pocket expense, what's the product that we're selecting. Just make sure everything lines up for you correctly and kind of get you a better sense of what the next milestones look like. Now, one of the action items for you once your offer is accepted is that you do have to make an earnest money deposit as a buyer. Usually that's 1 to 2% of your total sales price, and then that contributes towards your total out-of-pocket expense. That deposit in most states is protected by what we call the contingency timeline. And that contingency allows you to do your homework on the house. Things like getting the house inspected, getting the house appraised. So we want to make sure the home is worth what you're buying it for. As a lender, we'll be the one that orders the appraisal, but your realtor will help facilitate the inspection orders. And then, of course, as a lender, we'll get your loan approved for your financing. Okay. Now that contingency timeline depends on what state you're in, but it can be anywhere from 12 to 21 days, depending on where you're purchasing. but your deposit is protected in that contingency timeline while you take care of those homework action items. Now, step 4 is going to be a lot of the administrative tasks in the financing. We're going to be doing things like verifying your employment, verifying your assets, kind of getting all the financing designed so we can have an underwriter review everything. Now, the interest rate is usually locked in by that time, but there is some strategy, especially in today's market, of locking in at the right time, especially with us being kind of on the heels of the Federal Reserve meeting next month. A lot of our clients that are buying homes right now, we're kind of waiting to see what happens with the Federal Reserve meeting and how that influences interest rates. So there's some strategy in how we kind of guide you through that. Step 5 is going to be the loan approval. So we're going to have the approval issued by the underwriting team. It also brings us about 3/4 of the way through the entire home buying process. At that time, you're also probably at the end of your contingency timelines. And so as a buyer, if you feel good about all the investigative work you've done, then you can sign off on your contingencies, but it also tells the seller that you're ready to move to the final closing phase. As a lender, we're going to issue to you a final closing disclosure at that point, which gives you a 3-day cooling off period before we get to the final milestone. Now, the disclosure process in home buying is generally done all electronic, so you get various iterations of disclosures from the lender. The final disclosure goes out at step 5, and that, like I said, gives you that 3-day cooling off period before we get to step 6. Now, step 6 is at the finish line, basically. So at that point in time, you now have to sign documents in person with a public notary or maybe even attorney, depending on what state you're in. That signing process takes about an hour or so. After you've completed that, then you wire in final funds that you're contributing as part of your home purchase. Our team on the lending side then wires in funds for the home financing. Those funds get reconciled by the escrow or attorney's office that's being used in the transaction, and then documents get recorded with the county recorder's office. And that basically recording confirmation signals that you're now have the transfer of ownership to your name, as well as your deed for your loan confirmed and recorded. And then now the big time comes. Now, this is the time of celebration, because now once the recorded documents have all been confirmed, you become the official owner of the home. And when you get a chance, that's like the best day. That's the day of celebration. I got a chance to make quite a few calls of that day. I think with 4 or 5 calls of clients, they got the keys to their homes today. So probably the best part of my day is when I get a chance to make those calls, because, many of those relationships have started in classes just like this, where clients are just trying to figure out what homeownership looks like. They do a consultation, they go out and start looking for homes, and next thing you know, they're homeowners. And it really is the best feeling that day to be able to know that someone's accomplished all their goals of homeownership on that day. So if you're thinking about moving forward in the process, we love to be able to be a partner for you in homeownership. It's really a easy process. It starts with an online application. We only do a soft credit check. You can upload proof of income and assets, and then I meet with you for a follow-up video session to go through the design of your home financing. Our goal here is not to convince you of home ownership. It's to provide you all the tools and resources and support and set goals and objectives for home ownership. And it's a free service we provide to our communities in home ownership. Here's what that looks like for you. We're building a plan that includes where do I want to buy? What's my budget look like? Are there credit opportunities for me? Do first-time buyer programs fit for me? What are some of the things that are really important to me in home ownership? And again, that's about a 30-minute session we do over video. So we'd love to be able to get connected with you for something like that. We have some other resources that are available to you, like our mobile tools. So we have an app that's available on Android and Apple. You can use the calculator function in there. You can start your application process there, and it will also push notifications for you as you're moving through the process in home buying. Now, we're super proud of our partnership and really grateful for the opportunity to help support our Mississippi State alumni community. We also have other partnerships across the country that provide similar benefits. If you have friends or family or coworkers that think might benefit from some of our classes, go check out some of our upcoming classes at mortgageeducate.com. We love to be able to help serve others in homeownership. And here's my contact information. So if you do have any questions that don't get answered tonight, we are going to open it up for Q&A in just a second. Love to be able to kind of answer any questions for you offline. And we are going to put this video on our YouTube channel tomorrow, so you can kind of do a look back to it or share it with others. Our YouTube is J Made a Mortgage. It's also the handle for our Instagram too. We try to put a lot of good content out there on our Instagram and socials as well. So with that, I do appreciate her being so attentive tonight. And I want to kind of open it up for questions. Do we have any questions from the audience? All right, so let me just ask or answer the first question, which is just to make sure I heard you correctly, 2 years of college education counts towards the 2 years of employment history. Yeah, the answer is yes. So as long as that, I think the caveat would be as long as that education is related to your work. So like, let's say, for example, I spent 2 years at Mississippi State, finished off my accounting degree, and now I started an accounting job. Those would obviously connect, and that would fulfill the educational and or work history 2-year requirement. All right, great question. Any other questions from our audience? I know I'm in a difficult position because I'm right before dinner for most of you guys. So I do appreciate everyone kind of hanging out and listening to what we have to say tonight. So we do appreciate that. All right. I think I got, okay, I got one more. Okay, question in the chat was, have you worked with clients with no or new credit? And absolutely, yeah. So, some of our clients, in fact, I teach in international business school at UC Irvine, and we have a lot of international students that are just developing US credit. So if you don't have credit, there's a couple resources that I would kind of turn to. So Experian, which is one of the credit agencies, offers the Experian Boost program, which you can take like things like your rent payment or your insurance, your cell phone bill, and they can help kind of map that to your credit report to start getting what we call alternative trade lines on your credit and start developing a credit score. And if you haven't applied for anything, I would at least maybe try to apply for just a basic credit card through your bank or credit union. Usually they'll give you a limited credit limit that can start building that profile for you. To get on the grid, so to speak, of credit, you generally need at least about 6 months of credit history. That'll help you develop a credit score. All right, thanks for the question. And then the question is, do you recommend an online lender or a local lender for an easier process? Well, I mean, everybody has their choices of how they choose to do business. I think for our company, so we are a nationwide lender. So I think we're kind of the best of both worlds. We leverage technology. So we have a lot of online functions, but we also have the human touch of doing things like this and having one-on-one consultations with clients. I don't think geography is necessarily the determinant factor for selecting a lender. I think knowledge, experience, resources, and care is really kind of the attributes that a lender needs to have, especially as a first-time buyer. So just because you're in, Dallas, Texas, and I'm buying in Dallas, if you're not an expert in what you do and take the care and have the understanding for a first-time buyer, doesn't mean that necessarily it's the right fit. So I would encourage you to, hopefully have a conversation with us and see what the match looks like. But, obviously encourage you also to explore your options. But that's kind of how I would look at it. All right. Any other questions out there? Great questions. I'm glad you guys saved those up to the end. All right. I think we've done it. Okay, well, I appreciate everyone, and I want to respect everyone's time on today's session. So we'll send you out the recorded version or have that up on our YouTube channel tomorrow. I'll get you the presentation material as well. I hope you guys have a wonderful evening. I hope we get a chance to connect with each of you to develop your own home buying plan and really be a partner for you on that path towards home ownership. Have a wonderful evening, and we'll talk to you all soon. Good night.